Donald Trump winning the US presidency is bad news for Australian property. At the time of recording, he hasn't even officially won yet, and global markets are being shaken up everywhere. Strap in everyone, you're about to hear the story of 2024 and how Trumponomics impacts Aussie property. Let's go. Love him or hate him, Donald Trump himself doesn't change anything, but his major policy ideas do. In fact, they change a lot. The two major policy ideas that he has is a tariff system, which effectively means that any import going into the United States is going to cost more, protecting US manufacturers and producers from overseas competition. That could be downside impacts for Australia and for other parts of the world too. But the major policy change that he has is a massive tax cut program that effectively reduces the size of government and increases the fiscal deficit the United States government have. In fact, check this video out that analyzes his policy program.
So it's a choice between an increase in the US federal deficit of $3.5 trillion under Harris or $7.5 trillion under Trump, and possibly twice that depending on how much money the tariffs would raise.
But what does this mean? A survey of 50 American economists had this to say about his policies and its impact on US inflation.
Economists think it would definitely reignite inflation.
And this is what the New York Times had to say. IMF officials warned that the deficit was also increasing prices. Fiscal policies were adding about 0.5 percentage point to the national inflation rate. That is, when governments spend a lot more money than they're bringing in, and that's exactly what Donald Trump plans on doing, creating the biggest deficits that the United States has seen, excluding recessionary times, pumping money into the system. That is his economic policy agenda. And we felt this in Australia. Just yesterday, our own Reserve Bank shot a warning to our federal government about spending too much money. Check this out.
RBA Governor Michelle Bullock has issued a warning to the federal and state governments, asking them to not increase inflation with big spending election promises.
So you may be asking, Reedham, America's spending too much money. What does that have to do with Australia? And that's a good question. Look at this chart that shows the correlation of inflation all around the world in different countries. Now, yes, every country has its own domestic factors, has its own factors that drive its own inflation rate. But it's silly to think that we operate in a vacuum. If Australia's inflation rate is going up, it's probably because there's some global factors that are driving that to happen. And you see that in this chart when you compare France, Germany, Italy, Japan, UK, US, and the global headline inflation rate. They're all just tracking and moving along with each other. Yes, domestic factors are part of it, but most of it is driven by what's going on all around the world, and it's impacting each other. And you have this in interest rate decisions too. Policy settings that central banks have all around the world move in step with each other. Australia increasing our interest rate to 4.35% was a crazy idea a couple years ago, but it isn't crazy when you put in the relative context, because everyone's been increasing interest rates, and now everyone has begun cutting interest rates, and Australia is on the same sort of storyline, being like, when are rate cuts coming? Why aren't rate cuts coming? The reason why we're having those discussions is because the rest of the world is cutting rates, and we feel like in Australia, should we be doing the same? This is because the world is interlinked, and US spending so much more money because of Trumponomics is going to change the global inflation rate, and that is what changes the global interest rate settings and Australian interest rates in the years ahead. And guess what? This isn't just theory land that I'm talking about. It's 4 o'clock in Australia on election day in the United States. It's about midnight there. Counting is well and truly begun. And it's a little bit too early to say that Donald Trump's going to win, but they're probably going to call the election in his name in a matter of hours. And you have this already impacting markets. Check out the US 10-year Treasury yield curve. This is a measurement of what people expect interest rates to be in the United States over a 10-year period or in 10 years' time. That's what this is measuring. It's a product that effectively gives you a return on a 10-year bond on United States government debt. And you can see a dramatic increase in the price just today. And this is when the results started kicking in. You can see this increase in interest rate expectations over the next 10 years in the United States. We are feeling Trumponomics in our mortgage prices right now. Check out the Australian 2-year bond curve. This price has gone up from about 3.5, 3.6. So the expectation of Australian interest rates over the next 2 years, expecting a few rate cuts as of early October. That price has shot up to 4.1% and shot up again a little bit today. That is the expectation of interest rates over the next 2 years, and it drives fixed rates here in Australia. We have a little anecdote of this. We wrote a lot of a single product, Macquarie's 2-year fixed rate at 5.39 a month or two ago. That was based off this 3.5% 2-year bond price. That price is gone. You can't get 5.39% anymore for a 2-year fixed. That 2-year fixed price is going to increase again back to around that near 6% mark very, very quickly. Because if you look at this chart, the very idea of Trumponomics and the very notion that he could be elected and it feeling more and more real has been driving up the price of the 2-year bond curve in Australia and driving up expectations of interest rates. This isn't theory. It is in markets already showing up. Trump is having an effect today. We're also seeing this in the Australian dollar. Check this out. You'd expect to see this when you have the expectation that US is going to have higher inflation rates. That means the US are going to have higher interest rates to tame that inflation. You expect to see higher interest rates in the United States mean more money goes over to the United States, and that means the United States currency appreciates, and thereby the Australian currency depreciates. That is, someone in Australia is sitting there being like, hey, United States, you're going to have high interest rates. I want to place my money. If I've got 100 grand in my bank account, I'm going to place my money over there because I'm going to get a better return on it. This is the interest rate differential theory. The number one driver of our currency is interest rate differentials all across the world. And the expectation that United States interest rates are going to be high is going to drive currency flows out of Australia into the United States and depreciate our currency. You have this in our currency today. Check out today, as soon as the results started coming in around midday today, you have this, a very constant line about our price of currency sitting in around 66.4 cents. And then, whoo, down we come, roller coaster sliding down super fast when the news started to break that Donald Trump is killing it and about to be named US president once again. Our dollar plummeted. And that is another way you have this global inflation problem coming to Australia. Let me unpack that a little bit. When our currency buys less because it is being devalued, it means that we are importing inflation into Australia. If you want to go buy something from America, this morning you would have paid a little bit less versus right now you're going to pay a little bit more. That is inflation being imported from America over to us. That's how it works. That's why we have all this lockstep of inflation. When American inflation goes up, Australian inflation goes up because our currency goes down and we start paying more for all our goods and services. This is the world balancing happening and why you have inflation rates correlating all across the world. Currencies start readjusting and ours is already happening from the mere notion that Donald Trump is likely to win. Hey, and if you're looking at your mortgages and you want to save a little bit of money or you want to prepare yourself to potentially buy an investment property or review your finances, go in the description below and jump on the link here and our team would love to talk to you and try and help you with your financial goals. Okay, so now we have a clear picture. Trumponomics means higher inflation in the United States, higher inflation all across the world, higher inflation in Australia. And I want to unpack what all this means for our property markets and go state by state and try and uncover what this dramatic news story of 2024 means for Aussie property. So you have the first impact, higher interest rates here in Australia. Higher interest rates right now in 2024 and 2025 is a dangerous story for Australia. We've already lived through a really long period, a couple of years of high interest rates, all of 2024 with this cash rate paying above 6.5% for our mortgages now pushes back the expectation of rate cuts even further. We've already pushed it into 2025, and it could go from February to March to April to May to June, maybe even to the end of the year. It's pushing back expectation of rate cuts because we're going to be importing more inflation as a result. And that inflation rate that's coming down, that's going to be challenged a little bit because of Trump coming into power. We also have a few other factors. We are more susceptible. We are at risk a little bit more today than we were when interest rates started going up. You know, people have been living through this high interest rate environment for a period of time. They've got less savings. Businesses are more likely to be struggling today. There's more likely to be what we call a default cycle. Businesses that are just hanging on, waiting, being like, rates will get cut, things will get easier. I'll see another day ahead. Interest rates will come down and things will all be okay. There's a lot of businesses out there sitting on the sidelines on the edge of that cliff being like, I'll make it because interest rate cuts will come and help support my business. But that default cycle, all these businesses that are struggling may be pushed over the edge a little bit because we may have higher interest rates for a little bit longer, and that can push unemployment rates a little bit higher than we expect as well. This is what high interest rates do, and this is the transmission mechanism that the RBA expect to flow through to the Australian economy. Let's get a little bit specific as well. New South Wales and Victoria have higher mortgage balances, are more susceptible to a higher interest rate setting. That's why you've had the New South Wales and Victorian economies and jobs market feel the household sector. The people living in New South Wales and Victoria have been cutting back their spending from all these high interest rates, and that has really impacted some elements of our jobs market. In particular, the retail sector in New South Wales and Victoria have seen a big drop off in jobs, cutting off a percentage point in our total mix of employment. Check out this video for the full breakdown of each state and what's going on with employment markets. In that video, I talked about New South Wales and Victoria seeing the light at the end of the tunnel when interest rate cuts start kicking in. But if those cuts are smaller, or if they don't happen at all because of Trumponomics, then there's going to be more pressure in these economies and their housing markets, which are already under pressure with prices falling in both Sydney and Melbourne in the latest month's data. That could continue for a little bit longer, and it could prolong this little down cycle that we're in at the moment. Meanwhile, another theory that I have here, and I haven't fully fleshed this out because it's so raw, it's so new, is we are going to have potentially lower growth rates in our major trading partners. So the United States is a big trading partner of Australia, but it's not particularly massive. Our biggest export, iron ore, making up a quarter or a third of our total exports, a huge chunk, most of that goes off to China. But the US tariff plan is really a plan against China. It's a plan that says, hey, Chinese goods, you produce it cheaper than us. We don't want your goods in America anymore. We're going to tax you a whole bunch more so you stop selling your stuff to Americans, and our American businesses will do better as a result. That's their tariff plan. That's really the nuts and bolts to the idea, really simplified. That's their plan. So you may have the Chinese economy weaken a little bit in certain sectors. They rely on exporting. They make a lot of goods and they export it all around the world. So if they can't export it to the biggest consumer market in the world because of this tariff plan, then the Chinese economy may weaken a little bit. And what may they do in that case? The Chinese government's not just going to sit there and be like, hey, we missed our growth targets. Oh, America's done this. So, what do we do? Oh, well, we're just going to really slow down. They're not going to do that. They're going to be like, cool, we've got to stimulate other sectors. Sure, this part's slowing down, but our economy is ginormous. Let's speed up these sectors while these ones slow down. These sectors could easily be a stimulus plan, and when China goes through a stimulus boom, Australia benefits because Australia, we are the home of their iron ore and steel that goes into many of their sectors, particularly their property, housing and construction sectors. We are the home of where they get their steel from, and that makes up a huge chunk of our exports. So Australia may actually see this indirect weird benefit from a US tariff plan impacting China, creating a slowdown there, forcing them to create and manufacture an upturn in certain sectors, which benefits Australia, but importantly, it benefits iron ore prices. We've seen this a little bit before. Now, you can't take this one for one. You can't say, hey, Trump was president in 2016 to 2020. That's why iron ore prices went up. But I did look at what happened to iron ore prices before Trump was in power and after Trump was in power. And you do see something really interesting here. Iron ore prices were around $60 when he began his presidency in 2016. And then just before COVID hit, iron ore prices were $100. Iron ore prices shot the lights out during the Trump presidency years in 2016 to 2019. Meanwhile, in the years before that, iron ore prices were really high and started coming down a lot just before Trump got into power. So there's a lot of interesting information here when it comes to iron ore prices and the impact of Trumponomics there. This Trumponomics plan isn't different to his 2016 plan. The same America First attitude, the same sort of tariff plan there, the same ideas he had back then, and he's implementing them again. That's his plan for the future. So you could potentially see iron ore prices increase, and that has a particular benefit for WA, Queensland, areas that export our minerals over to other countries. They could have income booms that kick in and help promote their economies at the expense of New South Wales and Victoria. So my overall view is Trumponomics hurts Sydney property prices, hurts Melbourne property prices, and helps Queensland property prices, helps WA property prices a little bit. But the big news here is Trumponomics means higher interest rates means lower property price growth here in Australia. That's the big takeout from this big news story. We'll know more about this tomorrow, but it's an evolving story and it is the major story of 2024, and it impacts and reverberates across asset markets all around the world and here in Australia too. Hey, if you're finding this video interesting, then please do me a favor, hit that like, subscribe, and comment below, and I'd love to produce more and more videos like this for you.